Hey everyone, welcome back to the Gold Rate Insight channel. If you're new here, make sure to hit that subscribe button and ring the bell so you don't miss any of our deep dives into the wild world of economics, wealth protection, and smart investing. Today, we're diving into something big, something that's happening right under our noses, but you might not see it unless you're looking closely. The markets might seem calm on the surface, but behind the scenes, the folks pulling the economic levers are making moves that could flip the game board overnight. We're talking about policy shocks, political pressures, and a global financial system that's starting to show some serious cracks. And if your wealth is parked in the wrong spot, you might not realize the trouble until it's too late. The hidden wiring of the global economy. Let's start with a story from a recent episode that really opened my eyes, and I bet it'll open yours too. A single letter from a government agency, just a bureaucratic memo about potential tariffs on gold bullion, sent shockwaves through the global gold market. Prices spiked, physical shipments ground to a halt, and traders were scrambling to close out positions they thought were rock solid. Then, out of nowhere, a 4-word post from the president: "Gold will not be tariffed," hit the internet, and just like that, the chaos dialed back. The spreads tightened and the market exhaled. But here's the thing, that wasn't just a random blip. That was a peek behind the curtain, a glimpse of the frayed, overloaded wiring that's holding this whole economic system together. The hidden wiring of the global economy. Let's start with a story from a recent episode that really opened my eyes, and I bet it'll open yours too. A single letter from a government agency, just a bureaucratic memo about potential tariffs on gold bullion, sent shockwaves through the global gold market. Prices spiked, physical shipments ground to a halt, and traders were scrambling to close out positions they thought were rock solid. Then, out of nowhere, a 4-word post from the president: "Gold will not be tariffed," hit the internet, and just like that, the chaos dialed back. The spreads tightened and the market exhaled. But here's the thing, that wasn't just a random blip. That was a peek behind the curtain, a glimpse of the frayed, overloaded wiring that's holding this whole economic system together. Now you might be thinking, okay, that was a wild moment, but the market's fine now, right? Not so fast. That little flare-up wasn't an isolated hiccup. It was a warning sign. The global economy is like a house with faulty electrical work. Everything looks fine until a switch gets flipped, and suddenly the whole place is sparking. And right now, there are some big switches being flipped, deliberately, strategically, and with consequences that could last a lot longer than a day or two. So what's really going on here? Why should you care? And what does this mean for your gold, your silver, or whatever assets you're holding to protect your wealth? Let's break it down step by step, because this is where things get real. The Federal Reserve under fire. First up, let's talk about the Federal Reserve. You've probably heard the Fed described as the backbone of the United States economy, the independent institution that keeps the monetary system humming along, free from political meddling. Well, that independence is starting to look more like a myth than a reality. Lately, we've seen some pretty public attacks on the Fed. Think President Trump's threats to sue Jerome Powell, the Fed's chair, or the colourful nicknames and accusations of incompetence flying around. Now, you might shrug this off as campaign drama or political theatre, but it's more than that. This is chipping away at the perception that United States monetary policy is insulated from politics, and that perception matters a lot. Here's why. Around the world, central banks and reserve managers hold massive amounts of United States dollars and treasury bonds because they trust the system. But if they start to doubt the Fed's independence, if they think political pressures could sway interest rates or monetary policy, they'll start looking for alternatives. And guess what's at the top of that list? Gold. Physical, tangible gold. No central bank, no politics, just a hard asset that's been a store of value for centuries. We've seen this play out before in places like Turkey, where political interference in monetary policy tanked the currency and sent people rushing to precious metals. Now, I'm not saying the United States is about to become Turkey, far from it, but credibility is like a glass vase. Once it's cracked, it's tough to put back together. And when global investors start losing faith in the dollar or the Fed, they don't just sit around, they move. They move to assets like gold and silver, which don't rely on anyone's promises. The debt bomb ticking louder. Now, let's layer on another piece of this puzzle. America's debt. You've probably heard the numbers thrown around, but let's make it real. As of today, the United States national debt is sitting at a staggering $37 trillion. That's trillion with a T. Every single day, we're adding $4.2 billion to that pile, and we're shelling out $500 million in interest payments alone. Let that sink in. $500 million a day, just to cover the interest on what we already owe. And at the current pace, we're on track to hit the debt ceiling again by spring 2026. Here's the problem. There's no easy fix for this. You can't just grow your way out of a hole this deep, and cutting spending enough to make a dent would take a political miracle. So, what are the options? Historically, when empires, or even just big economies, get into this kind of debt spiral, they've got three paths: higher inflation, some form of default, or deliberately weakening their currency. None of those are great for anyone holding dollar-based assets, but they're especially bad if your wealth is tied up in financial instruments like bonds or ETFs that are just paper claims. This is where Ray Dalio's Changing World Order thesis comes in. If you haven't read his work, he talks about how late-stage empires, think Rome, think Britain, close the gap between what they spend and what they earn by debasing their currency. That's not a conspiracy. It's a pattern we see in history over and over again. When the money printer goes brrr, the value of the currency drops, and hard assets like gold and silver become the safe haven. That's not just theory. It's happening now, and it's why holding physical allocated gold and silver isn't some old-school hobby. It's a modern necessity. The trade war playbook. Let's zoom out a bit and look at the bigger picture. The trade war playbook. You might remember Stephen Mirren, a former Treasury advisor who dropped a 41-page bombshell a while back. He called it a user's guide to restructuring the global trading system. His big idea? Go after both sides of the balance of payments at once, trade and capital flows. On the trade side, that means tariffs, like the ones we saw threaten the gold market. On the financial side, it's about controlling capital flows and currency dynamics to shrink the US trade deficit and rebuild industrial capacity. This isn't just about economics. It's economic statecraft, a deliberate strategy to shift power back to America's Main Street. For decades, the US has been the world's financial sponge, soaking up excess savings from places like China, Japan, and Europe. In return, we've issued treasury bonds, stocks, and other financial assets, basically promises to pay later. That's kept the dollar strong, but it's also hollowed out manufacturing and ballooned our debt. Now the current administration is trying to flip the script. Instead of letting capital flood in, they're pushing it out, sometimes by design, sometimes by creating market squeezes that make foreign investors sell off US assets. The goal? Shift demand from Wall Street's paper wealth to Main Street's production. But here's the catch. These kinds of moves create shockwaves. A policy shift like a tariff or a capital flow restriction can blow up a futures market in hours. We saw it with that customs letter on gold bullion. Prices spiked, spreads widened, and traders were left scrambling. Imagine what happens when the shock isn't walked back, when it's not just a tweet, but a sustained, deliberate policy aimed at reshaping how capital moves through the global system. That's when things get messy, and that's when holding physical allocated gold and silver becomes your anchor in the storm. Why physical gold matters. So, why am I hammering on physical allocated gold and silver? Because not all gold is created equal. If you're holding a gold ETF or a pooled account, you've got a piece of paper, a claim on someone else's metal. It's liquid, it's tradable, but it's still a promise. If the system gets shaky, those promises can start to wobble. A fully allocated gold bar, on the other hand, is yours. It's in your name, it's not an IOU, and no one can take it away because of a policy shock or a market meltdown. Think about it like this. During that tariff scare we talked about earlier, gold ETFs and futures contracts were all over the place. Prices were swinging, spreads were widening, and traders were sweating. But if you had a physical gold bar sitting in a secure vault, you didn't have to worry about any of that. Your wealth was safe no matter what the futures market was doing. That's the power of owning the real thing. Now, I'm not saying you should ditch all your financial assets and go full-on gold hoarder. That's not the point. The point is diversification, spreading your risk across different asset types and jurisdictions. Some gold in a US vault, some offshore, and all of it clearly defined as yours, not just a market claim. That way, when the next policy shock hits, and it will, you're not left holding a bag of promises that might not be kept. The bigger picture. Structural pressures. Before we wrap up this first part, let's zoom out one more time and look at the domestic economy. Right now, things are looking a little frothy. July saw 71 major US companies go bankrupt, the highest monthly total since the pandemic. Consumer-facing businesses and industrial firms are taking the biggest hits, and inflation in core services is creeping back up, with supercore CPI running at a 6% annualized rate. Meanwhile, equities, Bitcoin, gold, and home prices are hitting record highs. That's the kind of cross-asset bubble that screams too much liquidity in a system that's starting to show some serious stress fractures. These aren't just random data points, they're signs of structural pressures, debt, policy uncertainty, and a global system that's shifting under our feet. The gold market tariff scare was a wake-up call, but it's not the main event. The real risk is in the bigger forces at play. A debt clock spinning out of control, a Federal Reserve under political fire, and a trade war playbook that's rewriting the rules of global capital. Audit your gold exposure. All right, let's start with the first step, auditing your gold exposure. This is all about knowing exactly what you hold, where it's held, and in what legal form. I know, auditing sounds like something you'd hire an accountant for, but this is simpler than it seems, and it's absolutely critical. If you're holding gold or silver, whether it's a few ounces or a serious stash, you need to be crystal clear on what you actually own. Because not all gold is created equal, and in a crisis, those differences can make or break you. Here's what I mean. Let's say you've got some money in a gold ETF. That's great, it's liquid, it's easy to trade, and it tracks the price of gold. But an ETF isn't physical gold. It's a financial instrument, a claim on a pool of metal that's managed by someone else. In normal times, that's fine. ETFs are convenient and efficient. But when a policy shock hits, like that tariff scare we talked about in Part 1, those paper claims can behave very differently from physical gold. Spreads widen, liquidity dries up, and suddenly your gold isn't as solid as you thought. Compare that to a fully allocated gold bar. When I say allocated, I mean it's yours, physically yours, with your name on it, stored in a secure vault. No one can lend it out, no one can use it to settle someone else's trades. It's direct property, not a promise. During that tariff scare, while ETF prices were swinging and futures traders were panicking, a physical gold bar just sat there, safe and sound, unaffected by the market chaos. That's the kind of security you want when things get messy. So how do you audit your exposure? Start by making a list of every gold or silver holding you have. For each one, ask yourself 3 questions. What do I own? Is it physical gold or silver, like coins or bars? Or is it a financial product, like an ETF, a futures contract, or a pooled account? Where is it held? Is it in a vault in the United States? Offshore? In your own safe? Or is it just a digital entry in a brokerage account? What's the legal form? Do you own the metal outright, or is it a claim on someone else's metal? Check the fine print on your ETF or account agreement. Does it say allocated or unallocated? Once you've got that list, you'll have a clear picture of your exposure. If you find you're heavy on paper gold, like ETFs or unallocated accounts, consider balancing it out with some physical, allocated metal. That doesn't mean you have to go all in on bars and coins, but having a mix gives you flexibility and security. Think of it like a diversified portfolio. You wouldn't put all your money in one stock, so don't put all your wealth in one type of gold. Why physical assets are your anchor. Let's take a moment to really drive home why physical, allocated gold and silver are so important in today's economy. In Part 1, we talked about the structural pressures building up, $37 trillion in United States debt, political attacks on the Fed, and a trade war playbook that's shaking up global capital flows. These aren't just headlines, they're forces that can disrupt markets in hours. When that happens, financial assets, stocks, bonds, even gold ETFs can get caught in the crossfire. Prices swing, liquidity vanishes, and suddenly you're stuck waiting for the market to sort itself out. Physical gold and silver? They don't care about market swings. They're not tied to a central bank's decisions or a politician's tweet. They're tangible, they're yours, and they hold their value no matter what's happening on Wall Street or in Washington. That's why I keep coming back to the word allocated. An allocated gold bar isn't just a hedge against inflation or currency devaluation. It's a hedge against systemic risk. When the wiring behind the economic wall starts sparking, you want something that's not plugged into the grid. Now, I'm not saying you need to build a vault in your backyard and fill it with gold bars. That's not practical for most of us, and honestly, it's not necessary. The key is to have a portion of your wealth in physical, allocated assets, stored securely and ideally spread across different locations. That brings us to our second step, jurisdictional diversification. Diversify your jurisdictions. Okay, step 2 is all about spreading your risk across different jurisdictions. This might sound fancy, but it's really just a way of saying don't put all your eggs in one basket, or in this case, one country. Every country has its own political and legal system, and those systems can affect how your assets are treated, especially in a crisis. By holding your gold and silver in multiple jurisdictions, you're reducing the risk that any one government's policies or missteps could put your wealth in jeopardy. Let's use the United States as an example. The United States is a stable country with a strong legal system, but it's not immune to shocks. An executive order can take effect overnight, even if it's challenged in court later. We saw that with the tariff scare. A single letter from a government agency sent the gold market into a tailspin. Now imagine a bigger shock, like a new regulation on financial assets or a sudden restriction on capital flows. If all your gold is stored in the United States, you're fully exposed to those risks. Now, compare that to a place like Switzerland. Switzerland's system of direct democracy means that major policy changes often go through a public vote, which can slow things down and add a layer of stability. That's not to say Switzerland is perfect or that the United States is unsafe. It's just that different systems handle decisions differently. By spreading your assets across jurisdictions, you're making sure no single system has complete control over your wealth. So, how do you do this in practice? Start by looking at secure, reputable storage options in different countries. The United States is a great place to store some of your gold. There are world-class vaults with top-notch security. But consider adding an offshore location as well, like Switzerland, Singapore, or Canada. These countries have strong track records for protecting private property and stable financial systems. When you're choosing a storage provider, make sure they offer allocated storage. Again, that means the gold is in your name, not pooled with anyone else's. Here's a quick tip. When you're researching storage options, check the provider's reputation, their insurance policies, and their auditing processes. You want to know that your metal is physically there, regularly verified and fully insured. And don't just pick a jurisdiction because it sounds exotic. Do your homework. Look at the country's political stability, its history of respecting property rights, and its exposure to global economic risks. A good mix might be 50% in the United States and 50% offshore, but the exact split depends on your situation and comfort level. The power of spreading risk. Why does jurisdictional diversification matter so much? Because concentration in any form magnifies risk. If all your gold is in one vault, one country, or one type of asset, you're vulnerable to a single point of failure. A policy shock in that country, a natural disaster, or even a legal dispute could put your wealth at risk. By spreading your assets across jurisdictions, you're building a safety net that can catch you no matter where the next shock comes from. Let's go back to that tariff scare for a second. When that customs letter hit, it didn't just affect United States markets, it sent ripples through global gold prices. If you had gold stored in, say, Singapore, which wasn't directly impacted by United States policy, your assets would have been insulated from the chaos. That's the power of diversification. It's not about betting against one country or system. It's about making sure you're not overly exposed to any one system's risks. This also ties back to what we talked about in part 1, the changing world order. As global capital flows shift and trade wars heat up, different countries will feel the pressure in different ways. The United States might tighten capital controls, Europe might face its own debt crisis, and emerging markets might see currency volatility. By holding assets in multiple places, you're giving yourself options and flexibility, no matter how the geopolitical chessboard shifts. The economy stress fractures. Before we move on to the third step in Part 3, let's take a quick look at the bigger economic picture, because it's all connected. Right now, the United States economy is showing some serious stress fractures. We mentioned in Part 1 that July saw 71 major United States companies go bankrupt, the highest monthly total since the pandemic. Consumer-facing businesses like retailers and restaurants are getting hit hard, and industrial firms aren't far behind. At the same time, inflation in core services is picking up again, with super core CPI running at 6% annualized. That's not just a number. It's a sign that the cost of living is squeezing people harder than the headlines might suggest. And yet, despite all this, we're seeing record highs in equities, Bitcoin, gold, and home prices. That's not normal. It's the kind of cross-asset froth that tells you there's too much liquidity sloshing around in a system that's structurally fragile. It's like blowing air into a balloon that's already got a few weak spots. One wrong move, and it pops. That's why these steps, auditing your exposure and diversifying your jurisdictions, are so critical. They're not just about protecting your gold, they're about protecting your wealth from a system that's starting to wobble. Keep cash and conviction for volatility. All right, here's the third step. Keep cash and conviction for volatility. This one's all about staying prepared and keeping your cool when the markets start acting like a roller coaster. If there's one thing we've learned from recent events, like that tariff scare that sent gold prices spiking, it's that policy shocks can trigger sharp, unpredictable moves in the markets. Futures prices swing, spreads blow out, and panic starts to creep in. But here's the secret. Volatility isn't just a risk, it's also an opportunity. If you're positioned right, you can come out ahead while everyone else is scrambling. So what does cash and conviction mean? Let's break it down. The cash part is about liquidity, having enough cash on hand to move quickly when opportunities arise. When markets get volatile, prices for assets like gold and silver can dip temporarily as traders overreact or liquidate positions. If you've got cash ready, you can swoop in and buy undervalued ounces at a discount. Think of it like shopping during a Black Friday sale. You don't want to show up with an empty wallet when the deals are hot. Now, the conviction part is just as important. Volatility can be emotional. When prices are swinging and the headlines are screaming about tariffs, debt ceilings, or Fed drama, it's easy to get spooked and sell at the worst possible time. Conviction means sticking to your plan, trusting your research, and remembering why you're holding physical gold and silver in the first place. These aren't speculative bets. They're your anchor, your insurance against systemic risk. When the noise gets loud, remind yourself. Physical, allocated gold and silver don't care about a politician's tweet or a central bank's latest move. They hold their value because they're real. Here's how to put this step into action. Set aside a cash reserve. This doesn't have to be a huge pile of money, but aim for enough to take advantage of market dips. Maybe it's 10 to 20% of your investment budget, kept in a liquid account you can access quickly. Avoid tying up all your cash in long-term investments because timing matters in volatile markets. Know your strategy. Before the next shock hits, decide what you're looking for. Are you buying more physical gold if prices drop below a certain level? Are you adding to your silver holdings if the gold-silver ratio shifts? Having a game plan keeps you from making impulsive decisions. Stay informed, but don't obsess. Follow the news enough to understand what's driving the markets, but don't let every headline derail you. Focus on the big picture, debt trends, policy shifts, and global capital flows, rather than getting caught up in daily noise. By keeping cash and conviction, you're not just protecting your wealth, you're positioning yourself to grow it when others are panicking. That's the difference between surviving a crisis and thriving in one. Tying it all together, your wealth protection plan. Now that we've covered all three steps, auditing your gold exposure, diversifying jurisdictions, and keeping cash and conviction for volatility. Let's put it all together into a cohesive wealth protection plan. Think of this as your roadmap for navigating the economic storm we've been talking about. The goal isn't just to avoid losses, it's to come out stronger, no matter what the markets throw at you. Here's a quick recap of the steps and how they work together. Audit your gold exposure. Know exactly what you own: physical gold, ETFs, pooled accounts, and where it's held. Make sure you've got a mix of physical, allocated metal to anchor your portfolio against systemic risks like policy shocks or market dislocations. Diversify jurisdictions. Spread your assets across different countries to reduce your exposure to any single government's policies. A mix of US and offshore storage, like Switzerland or Singapore, gives you flexibility and security. Keep cash and conviction. Stay liquid so you can buy undervalued assets during market dips, and stay disciplined so you don't panic sell when things get wild. This is where you turn volatility into opportunity. Together, these steps create a layered defense. Auditing ensures you understand your starting point. Jurisdictional diversification spreads your risk across systems, and cash with conviction lets you act strategically when others are reacting emotionally. It's like building a fortress for your wealth. Strong walls, multiple exits, and a stockpile of resources to keep you going. Why this matters now? Let's zoom out one more time to the bigger picture, because the stakes are higher than ever. We've talked about the structural pressures building in the economy, a $37 trillion national debt growing by $4.2 billion a day, political attacks on the Federal Reserve's independence, and a trade war playbook that's rewriting the rules of global capital flows. These aren't abstract concepts, they're real forces that can disrupt markets overnight. We saw it with that customs letter threatening tariffs on gold bullion, which sent prices spiking and traders scrambling. That was just a preview. The next shock could be bigger, longer, and aimed not just at one commodity but the entire financial system. Then there's the domestic economy, which is flashing warning signs. In Part 2, we mentioned the 71 major US companies that went bankrupt in July, the highest monthly total since the pandemic. Consumer-facing businesses and industrial firms are struggling, and inflation in core services is creeping up at a 6% annualized rate. Yet at the same time, equities, Bitcoin, gold, and home prices are hitting record highs. That's not a healthy balance. It's a sign of too much liquidity in a system that's starting to crack under the pressure. This is where Ray Dalio's changing world order thesis comes back into play. Empires in their late stages, like the US today, often close the gap between what they spend and what they earn by debasing their currency. That means printing money, weakening the dollar, and driving up inflation. When that happens, paper assets like bonds and ETFs can lose value fast, while hard assets like physical gold and silver hold steady. That's why your wealth protection plan isn't just a nice-to-have, it's a must-have. Getting started with your plan. So how do you actually put this plan into action? Let's walk through some practical next steps to get you started. If you're new to gold and silver or just looking to level up your strategy, these tips will help you hit the ground running. Find a reputable dealer or storage provider. Look for companies with a strong track record, transparent auditing processes, and full insurance for your assets. If you're storing offshore, check their compliance with local regulations and their history of protecting client property. Names like Gold Call, check the link in the description, can be a great starting point. They specialize in allocated storage and can guide you through the process. Start small if you're new. You don't need to buy a vault full of gold bars to get started. Even a few ounces of allocated gold or silver can make a big difference in diversifying your portfolio. Coins are a great entry point. They're affordable, easy to store, and widely recognized. Download an exit plan. If you're feeling overwhelmed, a structured guide can help you organize your strategy. Our free exit plan, linked below, walks you through auditing your assets, choosing jurisdictions, and preparing for volatility. It's like a cheat sheet for building your fortress. Stay educated. Keep learning about the markets, the economy, and the forces driving change. Follow channels like this one, read up on Ray Dalio's work, or check out reports from analysts like Stephen Mirren to understand the bigger picture. The more you know, the more confident you'll be in your decisions. As we wrap up this series, let's take a moment to reflect on why we're doing this. The goal isn't to scare you or make you feel like the sky is falling. It's to empower you, to give you the tools, knowledge, and confidence to protect your wealth in a world that's changing fast. The tariff confusion in the gold market was a wake-up call, but the real risk isn't in short-term price swings. It's in the structural pressures, debt, policy credibility, and the legal frameworks that govern your assets. Those pressures are rising, and they're not going away anytime soon. Your countermeasure is simple but powerful. Hold physical, allocated gold and silver in secure jurisdictions outside the banking system. Audit your exposure to know what you own. Diversify across jurisdictions to spread your risk, and keep cash and conviction to turn volatility into opportunity. Together, these steps create a plan that's not just defensive, it's proactive, letting you navigate the storm with confidence. If you're ready to take the next step, head to the link in the description to download our free exit plan. It's a step-by-step guide to building your wealth protection strategy, and it's designed to make this process as straightforward as possible. And if you've found this series helpful, please hit that like button, subscribe, and drop a comment to let me know what you want to dive into next. Maybe it's more on gold and silver, or maybe it's a deeper look at the changing world order. Let me know. Thank you for sticking with me through this journey. Let's keep building that fortress together, staying smart, staying safe, and staying ready for whatever comes next. I'll see you in the next video.